Coming up on Money Life.
The problem is we don't have 2% inflation. We've been running close to 3. So therefore, the math goes 3% inflation, 4% Fed funds, and 5% 10-year. And so there may not be that much room for the Fed to cut, but it does look like they are going to cut, and that will support at least parts of the equity market, even if it's just a couple of cuts, even if it's not what the current executive branch of the government wants. Even if it's just a couple, there can certainly be some support for the equity markets from the Fed.
That's Simeon Hyman, global investment strategist at ProShares. And in today's big interview, he's saying that recession is unlikely, but struggles and bumps, likely. But up first, Russell Rhodes, professor of financial management at Indiana University, co-host of the Academic Market Insights podcast, makes his debut on the show talking technicals. And later, we'll talk value investing as Jeff Oxshore, manager of the Oxshore Focus Fund, talks stocks in the market call.
To start, press any key. Where's the any key?
Well, whatever key you've pressed, it's the right key. Welcome to Life in the Key of Money. This is Money Life for August the 26th. I'm your host, Chuck Jaffe. Thank you so much for joining me. We have a great show planned for you today. The interviews are going to run long, so we're going to keep the intro and the closing a little bit short. I do want to tell you, if you are a small cap investor or you've been waiting for guidance on small cap, you will get some from both Russell Rhodes and Simeon Hyman. And they actually are fairly much on the same page, not entirely, but pretty close in terms of what they think could be happening with small caps. And it does not agree with every guest we've had. You shouldn't expect it to. I mean, disagreement makes a market. That's what we say all the time. There are other disagreements going on right now where, for example, President Trump has now fired, or says he's fired, Fed Governor Lisa Cook. We will see whether or not that happens. And we'll probably be talking on this show about what winds up happening if we see more pressure on the Fed. But again, you've got Simeon Hyman, like a number of experts on the show before him, saying you can press the Fed, but that doesn't mean you can make the economy or perhaps the stock market, since they are related but they're not identical, do what you want it to do. And as much as I love a market that's flirting with record highs and keeps wanting to go higher, I don't want to force something that makes me go, look at how good this looks now, that makes me say later, oh, this is really bad later. And we have had people talking about how maybe we've advanced things. Sarah Wolf yesterday from Morgan Stanley Wealth Management was talking about how the economists are maybe a little bit fearful that we've brought some things forward, which has helped the economy do well, but which also means that we've pushed a few things back, and they are coming. They're just not coming until 26 or 27. And that's fine. I don't mind that at all. The only problem that poses for me is literally a personal problem in that I'm 63 years old. So if you say, oh, recession's coming in 27, well, I better not be retiring at that point. And I know that Gail expects she's only got a couple years left of working. That puts you at sequence of return risk that you retire and you start drawing down on your money right as the market tanks. So that's that dangerous side of things. I'm Chuck Jaffe, financial columnist, your host here. You know what the show is all about, but if you want to get involved, don't be shy. Chuck at moneylifeshow.com. Thank you so much for the well wishes on Declan James Curis, my grandson, born on Sunday. He's doing great, going home today. And frankly, I hope you have things in your life that make you focus on the life side more than the money side. But right now, let's go focus on the money side, because 3 great interviews today. Russell Rhodes, Simeon Hyman, and Jeff Oxshore. It's a great day to live the money life. Thanks so much for being here. The talk starts next.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Don't get technical with me. But enough of my technical mumbo-jumbo. Allow me to demonstrate.
Welcome to Talking Technicals here on Money Life. I know you always like it when we give you new experts and new opinions. Well, today we are bringing in someone who has never been on the show before, but I'm excited to talk with him. And we are talking technicals. We're looking in at what the market is doing and what he sees happening. Russell Rhodes is Associate Clinical Professor of Financial Management at the Kelley School of Business at Indiana University. And I have had one or two of you go, you always bring in the traders and the guys who are doing this stuff as CMTs, but you don't always bring in any of the academics? Well, here's your academic, folks. But not only is he an academic because he's teaching at IU, he also runs part of the Academic Market Insights podcast on YouTube. He's got a long history working at hedge funds. If you want to find him, youtube.com/academic market insights. We have it linked up where you find him in our show notes or on our guest page. Russell Rhodes, welcome to Money Life.
Chuck, thanks for inviting me along.
First things first, let's consider my audience to be your students for the day.
Okay.
I'm going to ask a question that before we get to the market is really more about the job in terms of how much different is the market and how someone should react to it when they are a student and they're learning versus they are now, at the spot where they've got the credential and they're doing it. How much difference is there? Or investing is investing, so know how it goes, figure it out, and go.
Well, with students, I'm going to stick with undergrads. I teach both graduate and undergraduate students, but I think undergrads is a better example. And I think this translates to just about everybody out there that's thinking about trading a new market, which is what I would equate undergrads. They're thinking about trading, period, and everything will be a new market to them. You got to be very disciplined with respect to the size. I think everybody's aware of that. Part of my background, I ran a pure technical CTA for about 3 years. And when I would add a new program to it, needless to say, I would test it out using a one lot for maybe a week or two, just to make sure that it was behaving the way that I expected it to relative to the back test. But the point was very, very small size there. So if you're going to try something out, and then the other piece of advice that I like to give, and I hope this doesn't contrast with your belief, but I think paper trading is a waste of time. And I run, paper trading type contests for the finance club, and I'll have students that'll sign up. I think Bloomberg did one last year that I had students participate in, which are really nice for learning the mechanics of the markets, et cetera. But the emotional part, and a big part of what I do is behavioral finance oriented, the emotional part of paper trading versus trading real money, even if it's just buying an option that cost $1, even if it's just $100, you're going to pay more attention to that. You're going to lose interest with things that you paper trade. And I think one of the worst things in the world that could happen to you is getting in there, paper trading, doing very, very well, and thinking, being extremely overconfident when you start putting real money to work. So that's my number one. And that's for new traders across the board.
Well, I think it's important for my audience. Many of them come to technical analysis because they hear more and they want to be able to do more. And paper trading is a way to do it. But the idea of getting some skin in the game, even if it's a very small amount of skin, makes a lot of sense. And I like that they're hearing it from an academic who's not selling them something, as opposed to paper trading doesn't work. Come to my platform and do this. But let's move from that to the real world and where we're at right now, because we've got a market that is flirting with record highs. And so record highs are great. And you hope that what happens around record highs, that you get more record highs. But you, of course, worry that when you get to record highs, you got to back off. Are we at a spot right now in your take where we've got more upside potential or more downside potential?
I am going to fully admit that I've been bearish for longer than I should have been. I was bearish going into what happened in April. And for about half the move back up, I just stuck with it. We would get more knee-jerk reactions to the downside. Once it was very apparent that we were sticking within an uptrend. I think about late June was the last time we broke an uptrend based on what I was looking at. And then, of course, we resumed. But when we resumed the uptrend, I just got out of my shorts. And now I'm kind of in a wait and see mode. Although we haven't made a new high, and we're speaking in late August, we haven't made a new high in about a week and a half or so. So I'm thinking if we break below the 10-day low or so, that it might be the beginning of a down move. And I am fairly bearish moving into the fall, but I'm a tired bear, like a lot of the bears out there, a very tired bear.
If we have a bearish move, is your expectation that we need to kind of have a blow off and then we can resume going higher, or that we're getting ready for some sort of a sea change?
I think we're coming into a sea change. I think everybody's very bullish on what's going to happen next month with and I know this is outside of technicals, but a lot of people are bullish based on what the Fed's going to do, and they're going to cut rates at the September meeting. The odds of that are around 90% right now when you look at the derivative markets. What's funny is about 5 days before Powell spoke, where he gave us some certainty that we're going to get, that everybody believes we're going to get that cut now, and not just 3/4 of people. About a week before, the odds were around 90%. They dropped down to 75% right before he spoke, and then they popped right back up to 90%. And the stock market took off like gangbusters and went basically right back to where it was when we had a 90% chance of a cut. I know that's not 100% technical analysis, but in the environment we're in right now, I like to look at those Fed's odds and how they're changing. After Powell has spoken, it starts to back off a little bit, and you can see a little bit of weakness in the S&P 500 as well. I also like to use VIX as a confirming indicator and like to see it making new lows when we're making new highs. And that one's giving us a different signal right now with VIX hitting new lows. If we hit another new high in the S&P 500 and VIX does not put in a new low, I actually might dip my toe in on the short side again. I've had really good success with VIX as a contrary indicator, and I'd love to tell a story of where I came up with that one if you give me
Go for
a
it.
sec to talk about the financial press. Well, I was at SIBO for a while and kind of focused on VIX when I was there. And I was one of the people that corporate communications would roll out when the press had questions about VIX. I actually found when VIX was not doing what it's supposed to do, when it was not going down when the S&P 500 was going up, we would get reporter questions, is VIX broken? That almost always was a precursor to the market selling off. The one that really sticks in my mind was fielding multiple calls from, I think, 5 or 6 reporters in the 2 months leading up to Volmageddon. Those are the things that I would be looking at right now is just, are the Fed odds going to stick where they are? I mean, we're at a level right now where we're going to get that cut in September. And then the big question is going to be, do we get one in October or December? And the market's expecting 2 more this year, favoring the next one being in December. If they speed that up, that might make me a little bit more concerned over the market over the short term. But back to where you were steering me originally, I do think the economy is going to be sluggish for a little while. It's going to take a while for these cuts to work their way through. The cuts are probably a bit late, but I think they're justifiably late because often when we get one bout of inflation, we get another one. And I think the Fed's doing the right thing by focusing a bit on inflation until we get some consistent numbers that show that inflation's under control. And we just quite aren't there yet.
From a technicals perspective, it's always a market of stocks rather than a stock market, but we always talk about the market at where it is. And as the academic in this, is there more opportunity right now looking at and trying to divine what's next for the market more broadly, the way you were talking about with the VIX, or is it find the stocks that, have a little bit of direction and be doing a little bit more with options and things on individual names?
I like your second thought there as opposed to the first thought, especially because you hear that, all of the performance in the S, and I'm making this number up, so don't cite it. But this is kind of what we've been hearing lately in the market is, 20% of S&P 500 stocks are all of the upside performance this year. What a lot of people would probably be tempted to do is take a look at those outperforming stocks. If you're thinking about going to the short side, I actually think the underperforming stocks are the ones that you want to be taking a look at. They're the ones that are not necessarily in a strong uptrend. They're the ones that people probably had quite an affection for if they've made money in them this year. And they probably would not be the first stocks that people would exit if we start to get a pretty strong drawdown. You asked me before about advice that I give to students. One of the biggest pieces, and what I've been told, one of the best pieces of advice I've given students that want to be shorter term traders is it's not about buying low and selling high. It's about buying high and selling higher, or selling low and buying back lower. And behaviorally, those are some of the most difficult trades to do. But if you want to steer away from a broad-based index for a short position, I actually think you want to look at not not the stocks that have outperformed, but maybe some of the stocks that have been underperforming, for lack of a better way to put it, don't necessarily or have trendless charts, or are maybe even in downtrends, because it'll just get worse.
Last question in somewhat limited time. When we look at this market, what everyone's been expecting has been a broadening because, of course, it has been a market dominated by a few names. When you look at things and the conditions, is the broadening coming? Like, are we ever going to see the small cap rally that people have been telling us about for ages, or stick with those few names? I mean, even though you just said you like the underperformers, but when it comes to where the rally is or what we've got going on, it's still going to be a few names that are driving this.
Yeah, it's probably going to be a few names that are driving it. And I'm really glad you brought the small cap thing up, because in the academic space, we constantly teach that over the long term, small caps outperform large caps. That's one of the fama French factors. If you go back to 1989, the last day of 1989, and you look at the Russell 2000 total return versus the S&P 500 total return, they flipped about 2 years ago. So this long-term small cap outperformance, there's been a lot of Russell 2000 underperformance. And I think people look to the Russell 2000 as maybe the place to be, maybe once we bottom out, or just because it's underperformed the S&P 500 so much that maybe it's a better place to be. But you can see every time we get some sort of market weakness, the Russell 2000 and the small caps are underperforming large caps still. And I don't know if that fama French factor is going to be something that we're talking about 5 or 10 years down the road, unless something changes with respect to small caps versus large caps. But small caps, traditionally, that's been an area that has given you outperformance with a bit more volatility. Basically, it's given you a bit more volatility and underperformance now, and that's not necessarily a spot that you want to be in. I do, since I'm talking about the indices, I do like and I know this ends up focusing in on the few stocks that have outperformed, but the NASDAQ versus the S&P 500 performance, I always consider that a pretty good indicator as to how people feel about the economy, but just because NASDAQ 100 stocks are more economically sensitive. I would expect after a drawdown that the NASDAQ 100 will probably outperform to the upside.
Russell, great stuff. I appreciate you joining me on the show to talk about it. Let's do this again down the line.
Absolutely, anytime.
That's Russell Rhodes. He is Associate Clinical Professor of Financial Management at the Kelley School of Business at Indiana University. And if you want to learn more, well, go to youtube.com/academic market insights to get his take on what's going on with the market. And what's going on with Money Life? Well, we're just getting started on the August 26th edition of the show. Later, we'll be talking with Simeon Hyman. He is from ProShares. So stick around, because we're living the money life when we're back at it in just a moment.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
It's time for the big interview on the August 26th edition of Money Life. Returning to the show today, Simeon Hyman. He is Global Investment Strategist at ProShares. You can learn about ProShares by going to ProShares.com, also ProFunds.com. And I love getting a chance to chat with Simeon because ProShares, one of the most interesting fund companies out there, doing a lot of things that are intriguing, that are kind of testing some of the limits, that are testing the new ideas in the fund world and more, while also still providing a lot of the classic stuff that they've always done. Again, you can get more information at ProShares.com. But right now, let's check in with Simeon Hyman. Simeon, it's great to have you back on Money Life.
Thanks for having me.
Let's start with where we are in this market generally, because we have had a rally back to the realm of record highs, but we've done it on the back of not that many stocks. So are we at a spot where you're looking out and expecting a broadening, or is this going to carry on, or is what you're thinking about more is we have to take a step back from these highs?
The comments from Chair Powell were a big piece of this latest rally last week. And to some, I wouldn't call it surprising, but the fact that he said this in the face of the tariffs going into play is very, very interesting. if you think about where interest rates should be, you take the inflation rate, add 100 basis points, and that's kind of a good place for Fed funds. Add 200 basis points, and you've got the 10 year. So, in other words, if inflation makes it down to 2%, then a Fed funds of 3 makes sense, and a 10-year bond at 4 makes sense. The problem is we don't have 2% inflation. We've been running close to 3. So therefore, the math goes 3% inflation, 4% Fed funds, and 5% 10-year. And so there may not be that much room for the Fed to cut, but it does look like they are going to cut, and that will support at least parts of the equity market, even if it's just a couple of cuts, even if it's not what the current executive branch of the government wants, even if it's just a couple, there can certainly be some support for the equity markets from the Fed.
If you had to bank on cuts, given that you started that answer by talking about how it's surprising, are you in with the vast majority that says cuts are coming, but maybe not in with how many we're going to get? Or are you a holdout like I kind of am that is going to wait till the absolute last possible minute?
Well, I think the comments were pretty clear that at least a cut or two are coming soon. And I think the response of where that will be most impactful in the equity markets can be a little counterintuitive, because you almost want to turn your fundamental view almost upside down for a second. And what I mean by that is, if you look at debt levels in the S&P 500 today, they are at all-time lows. Net debt to EBITDA for the S&P 500 is 1.5 times. That is in the ballpark of all-time lows. Usually you say that's a good thing, except that may mean that large caps might not be quite as impacted by cuts because they're already so substantially delevered. Go over to small caps, they're over 4 times net debt to EBITDA. And not only that, small caps have more short-term debt that are more closely impacted by shorter-term interest rates than they have longer tenure debt tied to, say, things like the 10-year treasury. So almost paradoxically, if you're going to get a couple of cuts, we don't know if we're going to get 4, 6, or 8 cuts over the course of 18 months, but in the next couple of quarters, those interest rate sensitive small caps, which we just saw as Powell was speaking, had an outsized reaction to large caps, may certainly get a further pop over the next couple of quarters.
Do you believe that we will at some point see the small cap rally and that small caps will deliver to their potential? Because earlier on this show, we were talking technical analysis with Russell Rhodes, an academic from Indiana University. And he said that the picture on small caps, it's not just changing short term, it's been changing long term in terms of their potential and what they're delivering. And he sort of said you can't see a small cap rally without the Fed taking some serious action. So do we have enough serious action? And will small caps eventually pay off the way we'd expect?
I don't think you need 200 basis points of cuts for small caps to outperform, because remember, they have substantially underperformed for such a long period of time that you actually have at least relative valuation substantially in their favor. So you have price to book being at a substantial discount to the S&P 500. Now, I grant you that on a PE basis, the discount doesn't look exactly the same, because we have to give the Mag 7 credit. They're generating lots of actual earnings growth and cash flow. But still, when you're looking at just simply the value for dollar of book value, small caps are cheap. So you don't need massive amounts of Fed cuts to get at least a broadening that will include small caps. And by the way, they've been doing quite well this year. So the turnaround to some extent is already in play. I think there are a couple of ways that you can think of getting exposure here, which can be quite complementary. We have 2 ideas that we think are quite relevant at ProShares. And one is our ticker ITWO, and that is I2. That is our Russell 2000 high income ETF. And what it does is it uses a daily call option strategy to generate substantial income, but still capture the performance of the Russell 2. It's been running about almost 16% trailing distribution yield, but getting you almost all the returns of the Russell 2000. That's powerful because usually people who kind of know stuff about covered calls, you give up all the returns. Here, the innovation that ProShares has brought to the market is with daily options. You can approach call writing on a daily basis and get the income and the return. If you combine that with our other small cap opportunity, which is ticker SMDV, and that is our Russell 2000 dividend growth ETF, there you have compound growth of dividends over time. You have stronger balance sheets. So you're hedging your bets a little bit because with I2, you're really capitalizing on the overall Russell 2, which we acknowledge has a little bit higher debt levels sensitive to the Fed. If you combine that with SMDV, where you have stronger balance sheets for a more resilient longer-term exposure to the Russell 2000, you have a very nice combination that creates a very nice balanced profile that can really capture this opportunity, which again has two elements. Yes, the Fed catalyst, but also long-term underperformance that has a real valuation opportunity.
The emergence of options strategies, covered call strategies, and other option strategies has been a very big deal. It is right now sort of the hot area. We've talked about it on this show a lot in a lot of different ways. And although you were mentioning the I2, which, by the way, is yielding almost 17%, I don't care if this next comment is specific to the I2 or if you want to talk about option strategies in general. But it wasn't that long ago, and it might still be today, that, you know, if you said, hey, go find this thing and it's got a high double-digit yield, that you were chasing returns and you were putting yourself at significant risk. We're being told that all of these option strategies are reducing risk, yet they are paying that kind of yield. Hard to goose yield without taking extra risk. So I know people who think at some point we're going to see a blow up in somebody's fund because they've structured it in a way that it gets hurt or the market does something that really damages it. Do you worry about that? Do you worry that these strategies, while they've been back tested and they've been theoretically tested, haven't been market tested?
So let's take this just one step at a time. First, if you are stretching for yield without an option strategy, in other words, trying to go for very high dividend yielding stocks, you would 100% be chasing low quality companies that are about to cut their dividends and all that sort of stuff. And that's certainly a risk. And that's why on the dividend side, SMDV is focused on dividend growth, not high dividend yield. So we'll start there with step one. Now, step two, let's go into the option realm. And that is the nice thing here is that I2's approach with the daily options gives you the opportunity to generate that yield, but with roughly the same risk as the Russell 2000. Now, how does that work? When you execute an option strategy on a daily basis as opposed to classically like a monthly basis, a couple of things have happened. Number one, you're generating the income, but you're not increasing the risk level because you're taking advantage of this thing that the option guys in Greek call theta, which simply means that the value of an option declines more rapidly towards expiry. So if you write an option every day, you're getting actually a little bit more or premium per unit of time. Then number two, you're executing every day. So if you were called away, that's what a covered call strategy is. You're selling away the options to your stock. But if you're called away for one day, you're back in it the next day. So you're not giving up that much upside. So that combination is a very attractive one for generating income, but keeping risk roughly the same as the underlying, in this case, Russell 2000. The last piece of this puzzle, which is the underlying option market, is very robust for the dailies. In fact, what you see is a tremendous amount of volume, but very importantly, the volume is balanced between buyers and sellers. The innovation that was brought to market by daily index options on the S&P 500, on the Midcap 400, and on the Russell 2000 has been so valuable to people on both sides of the trade because folks who are selling options see the value that we just talked about. Folks who are buying options to hedge love the ability to match that on a daily basis. That market is very robust and quite balanced. So With a daily call option strategy, you're getting the income without buying junky high dividend yielding stocks. You're taking advantage of the fundamental math of options, and you're in a very robustly traded and balanced underlying market for those options.
What would we expect to happen with funds like that when the market gets wonky? Because again, you're looking at a yield of roughly 17%, but an investor should not be going, okay, I'm necessarily getting 17% in all market conditions, should they?
The best way to think about it is you have a risk exposure that's extremely similar to the Russell 2000 itself. So you will be up with the market, but you will be down with the market. And that is a feature, not a bug, because traditionally covered call strategies would not let you participate in the upside of the market. Here, you're getting the upside of the market, but yes, it's in effect close to a beta 1 strategy. And that's why it pairs so well with SMDV on the dividend growth side, because historically, SMDV has been quite a defensive approach to the Russell 2000. So when you put the two together, you've dialed down the risk of the Russell 2000 and you've dialed down your income in the near term. And you've also, you've dialed up your income in the near term, but you've also dialed up your income in the long term because those dividend growers are compound growing the dividends to give you that ultimate inflation hedge.
Let's bring this back around to what's going on with the market broadly. We've talked about small caps. The other area that people have been waiting to be good for a long time was international. We've had a significant rally in international this year. There seem to be two schools of thought on what happens next. One is this rally continues because valuations are better than what you're seeing domestically. The other is that was your rally and it's pretty much over. Which camp are you in?
On the developed international side, that's where we tilt a little bit towards. Emerging markets has a little too much exposure on the commodity front, which is perhaps one of the more vulnerable spots should we have even a mild, let's not even call it a recession, but a mild reduction in the level of global growth. But on the developed side, I think there's more legs to the opportunity. Look, we know that part of this developed international rally is on the hopes that Europe will finally shed the garb of fiscal conservatism and start to spend some money. And it does look like that is on the verge of happening. And if, knock on wood, there's some more peaceful outcome in the Ukraine, that's a further catalyst that's out there. So we would be in the camp of thinking that there's more legs to particularly the developed international opportunity. And that continues to be worthy of a spot in the portfolio.
In answering that question at the very beginning, you didn't want to use the word recession.
I did not want to use the word recession. The positioning goes back to the bond market in the following way. There's still a chance of a little bit of a steepener trade here. And for folks who have forgotten how this works, you don't have to go back too far. When the Fed cut over a year ago, the long end sold off. It is only in the context of quantitative easing that Fed cuts necessarily mean that rates come down across the board. In other words, this was what happened in the great financial crisis and then again in the pandemic, that the Fed bought longer-term bonds to make sure that cuts reduced yields on the long end too and further stimulated the economy. We're not necessarily going to get that this time around. Remember, in my math of 2, 3, 4, if we get to 2% inflation and maybe Fed funds gets all the way down to 3, that still suggests a 4% 10-year, which is pretty close to where we are. So I would suggest in a base case of no recession, which is just a little bit of slowdown in growth, you almost got to be a little wary of the long end of the curve. But in the context of the small chance of a real recession, that's when bonds would likely bail you out to some extent, because 4% on the 10-year is not 50 basis points that we had in not too distant memory. That's where you would have a real rally on the long end if we really had a recession, and then instead of just a slight slowdown in growth. So I do think it's the less likely case, but it's out there, and you still need long duration paper to diversify equities in the event that is one of the outcomes.
We entered this year with people not necessarily thinking we'd get a recession, but still talking about what kind of landing we'd have. No one's talking about what kind of landing we've had now, and no one's talking about when. So when and what kind, when it finally happens, is your expectation?
The question is more of whether we would have an earnings recession, because let's assume that the economy is engineered this softish landing and we avoid literally a contraction of the economy. That doesn't necessarily mean that we wouldn't have an earnings recession, but I'm still in the camp of suggesting that even an earnings recession is somewhat unlikely, at least in the next several quarters. The earnings season just wrapped up. You got the retailers coming in, and we do have Nvidia this week, so everybody's holding their breath. But 10% year over year on the S&P 500, pretty darn healthy. And yeah, there's still earnings growth opportunities, as we were discussing, in mid and small caps. So I still think there's room for earnings growth. The wild card here is tariffs. Remember, they are under judicial review. We don't know if they're going to completely hold up. There's still more to reveal itself over the course of the next couple of months as to the direction of travel on the tariff front. But it is something that could have a very near-term impact on margins. You got to go back to your freshman economics class and remember what tariffs mean. People keep saying who's going to pay for them, assuming that the demand is elastic. If you draw your supply and demand curves and a tariff comes in, then prices rise, but only partially to the level of tariffs. So in some sense, you might say that the cost is split between consumers and producers. But then remember this little triangle in your freshman class that was called the deadweight loss. What does that mean? Well, if you think about it colloquially, prices are a little higher, margins are a little lower, and volumes are a little lower. So everybody's a little unhappy. Everybody's a little sad. Consumers pay a little more and have a little less. Producers sell a little less and have slightly tighter margins. And there is a nick to GDP. That is the triangle of deadweight loss. So that could bring us, somewhere in that kind of 1% growth range, which is notably below a trend growth rate and could nick earnings growth over the next several quarters.
The market rally that we're in now in 23 and 24 was really driven by rate moves, and in 25 has been driven by earnings. So if you worry that we're going to see earnings slow, will the rate cuts be enough to keep this going? Or when we get that combination, not enough on rate cuts and not enough growth on earnings, there's that intersection several quarters down the line where, hello, trouble.
If we simply get a reduction in earnings growth, but not an earnings recession, and we get a couple of rate cuts, I think we're fine.
I mean, I think a lot of people would be happy if that's what happens and continues. We'll see how it plays out. Simeon, always great to catch up with you. I look forward to the next conversation down the line. Thanks for joining me again on Money Life.
Thanks for having me again.
That's Simeon Hyman. He's global investment strategist at ProShares. And if you go to ProShares.com and you look for insights, his are worth finding and reading, because we didn't even get a chance to get into some of the stuff that he's been writing about, talking about things like the healthcare industry and more. So there's plenty there for you to check out again at ProShares.com, also ProFunds.com. We'll be back to put a bow on this show. Stick with us all the way to the end. You made it this far. Don't quit on us now. We'll wrap things up in just a moment. Jeff Oxshore, manager of the Oxshore Focus Fund, AUXFX. He's here. We're talking value investing, and it's time for the Money Life Market Call. Welcome to the Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they are putting it all together. And returning to the Market Call, he was actually our very first Market Call guest this year in 2025. Coming back today, Jeff Oxshore. And if you want to learn more about him or the firm, or you want to find the fund, Oxshore Focus, AUXIER. I'm spelling it because it's oxshoreasset.com. Jeff Oxshore, it's great to have you back on Money Life.
Oh, thanks, Chuck. Appreciate it.
We always start with methodology. You are a value investor, but value means different things to different people. So help us understand what it means for you and what it is that you look for that says this is what I want to buy, and that's what I'm going to leave for everybody else.
Yeah, we try to be, have a voracious research effort and keep up on the operating reality of a lot of really good businesses. And then we look for, that double play investment where you have a margin of safety price where we can get a great price with improving fundamentals so we can get, the double, triple play. Most of, it's day to day really focusing hard on the operating fundamentals and earnings again drive stock prices. And so we're really zeroed in on the execution of these companies.
When you have a market that's at record highs, but you haven't had necessarily broad participation, does that mean you are finding bargains, that's easy for you to find things you want in these conditions? Or the market's at record highs, it's not going to be easy to find anything that's a good value?
Yeah, well, the market, has mostly been an AI trade as far as the general market. That tech, the top tech names have overweighted the market, but it's not dissimilar to like 1999 where, AI is taking all the oxygen out of the room, basically, So, with the NVIDIAs and the build out of this huge AI and the CapEx. And so it's kind of created its own weather. But, underneath, there's a lot of really good businesses that we're finding, like the insurance space has really sold off in the last quarter. Things like Progressive, probably the best auto insurer, where you mandate you've got to have insurance. And, in today's market, again, there's a lot of algo trading, like maybe 85% of the trading is headlines based on algorithms. So, you'll have huge drops, and we try to know our businesses better than the market. And then, you can do really well, and you can do well in these unloved areas. And that's where we have operated over the years anyway.
There are people who have said over time, value investing is dead. We have to redefine value investing, et cetera. As you watch the fits and starts that happen with value investing, is this a good time for value investing? Is this a rebounding time for value investing? Or is this one of those times where because it's been the AI trade and because it's been momentum and growth, it's been a slog?
No, I think you're always trying to make great buys. We try to always make it on the buys, and a lot of it has to do with the type of business you're in. And obviously, like the best performers tend to be higher valued companies. So we try to buy those when they have, a temporary problem. And we've identified, the great compounders over the years, you want to be in those, but you try to buy them at a price point that represents a margin of safety and where you can get the double, triple play. So if you're looking for the best businesses, you're always watching those and when they get hit. And, there's trends like digitization, and as we become more digital in businesses and in companies, we're in a market that rewards execution, but really earnings drive the stock. So if your earnings are going up and if you buy it right, but the flip side, if, Kodak was the number 2 employer in 1989, right? So you got to be on the right trends and then you want to buy right. But yeah, I think this whole value growth deal is a little distorted. You get momentum and they call that growth, but if you have good growing solid cash flows, you can do really well. We have our best performers have been like Canadian maintenance companies, so it's more being a business analyst and then buying right, but in determining that demand over the next 5-10 years.
Well, let's talk about a name or two that stands out. You've dropped a name or two as you were discussing it in some industries that you like, but what are the areas of the market that you like right now?
Well, like I say, the health insurers have been blasted, United Health and Cigna and Elevance, they kind of mispriced their insurances last year. But I think these are very strong, durable franchises that have been just pummeled, and there's huge insider buying, especially United Health and Elevance. And Cigna is another one that's, and these companies have enormous bond portfolios to act as a ballast. And things like Progressive recently was hitting lows. Arch Capital, insurance is extremely dull, but the pricing has kind of come off a little bit. But those are enduring franchises that we like to buy to where, you got really low valuations in that area. There are things coming down like things like Deckers, which is down 50%. You just got to look at each company, like AIG, they've got 15% growth at a 9 to 11 multiple, low price to book. International companies, Alimentation, Couche-Tard, is got a great 20-year operating history. And so there's like in Brazil, Arcos Dorados, the number one McDonald's franchisee in Latin America, and with Argentina turning, that's kind of a cast. But there's a 12% grower at 10 times earnings, So there's all kinds of businesses out there that Fiserv has been blasted. They've had 40 great years of operating history.
So it's very interesting to me, Jeff. It's very interesting to me that you've dropped a number of names here. Several of them have been stocks where they've been beaten up pretty severely. Like you are going in, UNH being one of them, Fiserv you just mentioned, et cetera, where they have really had some troubles. And by the way, that has meant that the opinions on some of those stocks, we've talked about them with guests, have been very mixed. I mean, obviously with like UNH, you're on the side of Warren Buffett, who was buying in as Berkshire Hathaway was buying in, et cetera. But how much for you right now is, if you want to find good values in a market at record highs, go where things are bloody?
We're more business analysts, So we went at United Health back when Hemsley, the current CEO, went in. The stock was 42. The free cash flow yield was like 30%. So it's all a function of, like, we have a company called British American Tobacco, and a year ago it was 6 times earnings. It had an 8% yield, and now it's gone up 60%, and it's 10, 11 times earnings. So you just these companies, Chuck, since 1982, I've gone through 1,800, 2,000 companies a year. And so you just watch the ones you want to own, and then when they get hit, you buy them, So it's not really, you're just waiting for the opportunity. We had bought some Celsius I've watched for years. We've had Monster beverage, Monster's up 70,000% over 20 years. And Celsius is another one that it got blasted. And so, it's really a function of being really having this consistent research effort to be a great business analyst. And then, we have a company called Gates. They do like hydraulic hoses. Well, if you have a farm, you're blowing out hydraulic hoses every week, and that stock was like 10 times earnings and double-digit growth. So, that's the thing. It's just investing is a craft of the specific. You need to really focus on the specific, understandable variables. And then when the price is right and you get the double, triple play, a lot of companies, like I say, they're small. Everybody goes, well, you can't make money in small companies. We made our biggest winners have been in small companies, It's mostly because we look at the business, we look at the management, and management's with great heart and soul,
And what makes you sell? Once you find management with great heart and soul, you've got a great business. Is it simply that, okay, I've gotten that opportunity, and then once the rest of the market has recognized it and bid it up enough, you're out? Or is it you find something else that you like better, so it's a better use of the money?
Well, we look at that every day, Chuck. And, like we have Visa, MasterCard, MasterCard at 20, I think. And, we have some Costco all the way back to before Jim Sinegal went public, it was like 18 cents. Well, the mistake on Costco is selling any of it, 18 cents to 1,000, right? Where are you going to? So what we're trying to do is make, 10, 20 times our money over 10 years. We're not really looking to trade. I mean, like Visa and MasterCard have been unbelievable. I think we're up 2,000% in MasterCard, and it's been overpriced. We bought those at the same week. They got to 13 times earnings. That was another one. We were ready, then negative news on interchange fees. And so, the stock goes from, 2 to 5, whatever it is, 90 or whatever. So that's what I've learned. We have Philip Morris. We have clients that are up 100-fold. And, that stock has never had good news since we've owned it, And that happened. I had to call Buffett back in 82, and he had all these tobacco stocks. I go, why on earth? We're joggers and everything. And I went back 100 years, and I go like, wow, And so, I mean, that's why it's the craft of the specific. I mean, no one in the country has held that stock, I guarantee you. I think we're probably the only ones, But so that, it's back to like doing your homework. And there's huge opportunities if you just work hard and then follow. Most of the things we buy, I've followed for, at least 5 years before we buy them.
Well, now we're going to put you to the test of our audience, and maybe we'll find that they have found something that you would say you would sell, et cetera, as opposed to maybe not just buying, because there is a difference between not buying it and selling it.
quick and dirty.
Love that game.
Yeah, we love getting quick and dirty, our lightning round. We love doing it with our guests, especially when they can articulate what's going on with the stocks that we are talking about. And that's what you're getting from Jeff Oxshore. He is the manager of the Oxshore Focus Fund. Oxshore, A-U-X-I-E-R, OxshoreAsset.com is the website for the firm. AUXFX, the ticker for the fund. You know how quick and dirty works. So we're going to jump in with a couple of requests from Sam in Waterfleet, New York. The first is for Parker Hannifin. It's ticker symbol PH.
Chuck, this is a great company. Again, they do, I think over 4,000 replacement parts for aerospace industry. So we love repair replacement. That type of business is a really good business. They've been executing. It's not a buy here, but, if it would pull back 20%, it would definitely be a strong buy. Just very well managed and, like I say, small repeat replacement type business, especially in the aerospace defense, have been really strong.
Good company, not a good stock to buy at this point.
I'm just taking my time before making the move.
Yeah, wait for that pullback, potentially as much as 20% before you are buying PH Parker Hannifin. Sam's other request was for Kraft Heinz Company. That's KHC.
Yeah, interesting. And Warren Buffett bought this, I think back in 2013, they bought Kraft and then merged it with Heinz in 2015. They just recently took, I think $3.8 billion write down. Berkshire owns like 27% of stock. So it's really been an underperformer. I mean, that part of the supermarket, processed foods and what have you, has been hammered by private labels. So the stock's interesting. If you buy it for a bond, it's good. It pays 6%, dividend safe, PE's 10. And this is kind of what you'd call a value trap. The trends have gone to healthier food and away from processed foods in this. Now they are going to break it up. So I think I would probably hold it. You could buy it for a bond return and a catalyst with a spinoff, but you still have Berkshire who owns a huge chunk. So it's more like a bond play than anything, but it could, if you get 6.2% and the stock trades up 10%, that's in today's market when the PE of the market's 23, 24 and the dividend's 1.2 on the S&P, it's definitely got the value parameter,
It's got a little of everything because it could be the bond play. It's kind of a hold to you, but it does have a little bit of upside potential.
Just go slow and be smart.
We're going to label it a hold, again, looking perhaps for a better price on KHC Kraft Heinz. Pat in Swansea, New Hampshire wants to know about Alaska Air Group. That's ALK.
Yeah, the management's really doing a lot of great things. They're expanding the rewards program. They bought Hawaiian Air. You've got some of the capacity coming out, with the recent, some of the bankruptcies in the industry. So the airlines, they're looking for a rebound, for earnings to rebound from 330 to 625 next year. So it's not the type of business we like to buy because airlines are just a tough business. But with fuel down and they're expanding their routes and the rest to Hawaii and a really good management, it's still, like I say, it's got improving fundamentals right now with capacity coming out, energy low, and expanding rewards. So it's closer to a buy than a sell, I would say.
Again, with the caveat that Jeff's not a big fan of the airline industry. He is expecting a fairly soft landing there for ALK, Alaska Air Group. Lance in Bethlehem, Pennsylvania wants to know about TSCO, that's Tractor Supply Company.
And it's a great business. People who are in these mini ranchettes or whatever, they buy their chickens and then they have to buy the chicken feed, or they buy their horse and they got to buy the meds for the horse. So it's a really good recurring business, just a little pricey, and they've been hit a little bit with tariffs, but this trend, toward buying small properties has continued. They've just done a great job. It's not like a Target or whatever. I mean, if you have a small farm, which I do have a farm, so I can tell you, they kind of have you. The feed store, they've got you, and they charge like $30 for a bale of hay, which I can't believe. But anyway, it's a really good business. I'd buy it 20% cheaper.
Good company, not yet buyable.
No money changes hands today.
Wait for a better price on Tractor Supply Company, TSCO. And last, for Greg in Tully, New York, Lincoln Educational Services Corp., LINC.
So this is a great company. I actually met Scott Shaw, who's the founder CEO of this, 5 years ago, and I met him. The stock was $2, and he was the real deal. We actually, full disclosure, bought it there, and then they train, diesel mechanics. They train welders, electricians, skilled labor, and he's done a great job. The stock's gone from like 2 to 20, and in fact, full disclosure, I just met with him again. But this is the type of thing you talk about dull, and you say, well, here's a small cap. You can't make money in small caps. Oh, you can't make money. Well, here's a heart and soul. This Scott is really, he's poured his heart and soul into this company, and they're clicking on all. I mean, the demand for electricians, the demand for welders, all these data centers and everything. I mean, there's a huge shortage. And so this one's one I would be a buyer on any weakness from here.
When you buy here, it's going up.
Well, maybe you're waiting again for a little bit more weakness, but either way, that's a buy on LINC, Lincoln Educational Services Corp. And speaking of good buys, we've got to say ours now to Jeff Oxshore. But Jeff, always great to catch up with you. Thanks for joining me on the show.
Thanks for having me, Chuck. You have a great show. Appreciate it.
Jeff Oxshore is the manager at the Oxshore Focus Fund. He is the head of Oxshore Asset Management. Go to Oxshore, AUXIER, OxshoreAsset.com to learn more about the firm and the fund. And we'll come back. We'll tell you where Jeff agreed or disagreed with some recent guests. Then we'll cross the finish line together. This is Money Life.
Asset managers, you know how hard it is to stand out in this crowded space. VettaFi is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, VettaFi can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at VettaFi.com.
Thanks so much for staying with us. We are back to wrap things up. A lot to get through in not much time because we had a lot of crossover in that interview with Jeff Oxshore, though most of it came before we got to Quick and Dirty. So let's just jump straight in. The first stock he talked about was Progressive, PGR. Mike Bailey from FBB Capital was the first stock he talked about. It was his poster child back on April the 3rd. Greg Halter, Director of Research for Carnegie Investment Council, had it as a buy on March the 27th. United Healthcare was a buy today. Jeff Mullenkamp from the Mullenkamp Fund was selling it on the 14th of August. Hank Smith from Haverford Trust was selling it back on the 15th of July. Mike Bailey was buying it, however, from FBB Capital back on April the 3rd. Go further into it, you got to Arcos Dorados, ARCO. Michael Campagna from Morris Capital is a longtime buyer. He reiterated that when he was on the show on April the 23rd. Fiserv was a buy from Jeff Oxshore. It was a sell from Tom Martin from Globalt Investments a week ago on August the 18th. Then you got to Visa. David Miller from the Catalyst Funds was buying it on August the 1st. John Smucker from Marriott Investment Partners was buying it, although it was a qualified buy back on April the 15th. And MasterCard, Hank Smith from Haverford Trust was buying that on July the 15th. Greg Halter was buying it back on March the 27th. And I said not much crossover during Quick and Dirty. It was only Tractor Supply, TSCO. It was a hold to a buy at a 20% lower price today. Kirk McDonald from Argent Capital was buying it back on April the 8th. Tomorrow, Aniket Ulal, head of ETF data and analytics at CFRA, will be here talking ETFs in the market call. So that will be a fun one. And we've got some other things planned, so plan to be here with us. Sometimes we get to where there's a show that I just can't tell you everything because I don't know as we sit here right now. Meanwhile, if you're looking for something that you want to celebrate, well, today is National Women's Equality Day, which commemorates the adoption of the 19th Amendment, which guaranteed women the right to vote. And it was 1920 when it actually was adopted by all the states, which is only 105 years ago. And as you watch things that are potentially threatening voting rights, it is worth celebrating. It's also National Webmistress Day. Webmistresses have equality with webmasters, I guess. It is National Dog Day.
Did that dog just say hi there?
Well, you can say hello to a dog today because it's National Dog Day. It is Make Your Own Luck Day.
You could ask yourself a question. Do I feel lucky?
Well, I hope you do feel lucky. And then you are always lucky when you have toilet paper. It's National Toilet Paper Day. Don't we celebrate that one every day? Shouldn't you be celebrating toilet paper every day? I would think so. It's National McChicken Day, and it's National Cherry Popsicle Day. My guests today were Russell Rhodes, Associate Clinical Professor of Financial Management at Indiana University. And oh, by the way, the website, it's youtube.com/academic market insights. I don't use YouTube enough, although we have our show on YouTube. Be great if you like YouTube. Go check it out there, please. We'd love to have you like it and subscribe there. That's a great way to get the show or expose us to more people. We also had Simeon Hyman, Global Investment Strategist at ProShares, ProShares.com. And, of course, Jeff Oxshore from the Oxshore Focus Fund, OxshoreAsset.com, the website there. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my puppy. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from John Dos Passos, who said, "Love is cheap. You can buy it anywhere. Lives are cheap. It's money that's dear. You have to work days and sit up nights thinking how to make money." Well, we hope you don't have to sit up too much, and we hope you'll keep money in perspective, because I don't know that love is cheap, but I do know that the best thing you could do for your money, until we do this again, is just not worrying too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
You know, that reminds me. There's something I've been wanting to say to you since the day we met. Goodbye.